Ladies and gentlemen, good day and welcome to the Q4 and FY22 earnings conference call of Nuvoco Vistas Corporation Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Disa from CDR India. Thank you, and over to you, sir.
Good day, everyone, and thank you for joining us on Nuvoco Vistas Corporation Limited's Q4 and FY22 earnings conference call. We have with us today Ms. Madhumita Basu, the Chief of Strategy and Marketing. Before we begin, I would like to mention that some of the statements made in today's call may be forward-looking in nature and must be viewed in conjunction with the risks that the company faces. The company does not undertake to update them. A statement in this regard is available for reference in the presentation shared with you earlier. We will begin the call with opening remarks from Ms. Basu, who will share perspectives of the business model and strategy and the outlook of the company. Post this, we will have the forum open for interactive Q&A session. I now would like to hand over to Ms. Madhumita Basu.
Thank you, Gavin. Good afternoon, everyone. It gives me great pleasure to welcome you all to the Q4 FY22 earnings call of Nuvoco Vistas. Looking at the year gone by, financial year 2022 was challenging for the entire industry. On one side, cement demand growth was a bit impacted during the year by unprecedented factors in different regions at different points in time. On the other hand, soaring coal costs since August 21 weighed on margins. While overall pan-India cement demand still grew at a good rate of about 9 to 10%, East India, which is our major operating region, witnessed its worst hit year, primarily caused by poor weather conditions in the states of Bengal and Odisha, coupled with a long transporter strike in Chhattisgarh and the sand availability issue in our principal market, Bihar, due to the ban on sand mining. I have not seen so many factors playing along almost simultaneously in so many years. If I, however, particularly focus on Q4 FY22, the eastern region has witnessed a good demand rebound during the quarter on a sequential basis, driven by improvement in ground level activities with seasonally stronger periods, improved labor availability, and revival in sand mining. Price hikes during the quarter were led by the strong demand rebound and high fuel costs. East witnessed sharper price hikes compared to most of the regions in India, with the improvement in capacity utilization and given a low Q3 base. Presently, we are looking at a modest cement demand traction in the market amidst a seasonally healthy construction period. However, fuel prices remain elevated. Dominant inflationary pressures have also started affecting other input material prices. Indian government's recent intervention in stabilizing the inflation is appreciated. This should not only help in containing the soaring costs, but will also give necessary support to cement demand. In this background, we continue to focus on managing our costs through our internal levers, getting as much linkage coal as available, and increasing the alternate fuel rate. Price hikes taken in late Q4 FY22 are still holding out and providing benefit in Q1 FY23, while further price hikes were taken in April in both North and East regions. I would like to mention here that cement is a cyclical sector and one should take a long-term view, setting aside the near-term headwinds. For a developing and growth economy such as India, the outlook for the cement industry is very positive, given the extent of infrastructure and housing requirements in the country. The cement demand is slated to grow at a good pace, led by government's focus on affordable low-cost housing segment, increase in infrastructure spends across sectors such as roads, railways, metro rail, smart cities, and irrigation, coupled with the pent-up demand in urban housing and industrial capex plans with the ebbing impact of COVID-19 pandemic. Rural demand is also set to pick up with the prospect of a good Rabi income and the expectation of a normal monsoon for kharif crops. I would now like to quickly run you through the update on our ongoing expansion projects. We are on track on the clinker capacity enhancement projects in Vistas and Nimbol by 1,000 TPD each through debottlenecking. Out of this, we already achieved 500 TPD capacity enhancement at Vistas facility during FY22. Both the projects are set to be completed in FY23. Second is on our north expansion at Bhiwani, Haryana, which we announced during the previous quarter results. Just to touch base on it again, we are setting up a 1.2 million tons per annum grinding unit at our existing Bhiwani cement plant in Haryana. In FY22, our volumes in North improved by 20% YOY. We successfully launched the Double Bull brand and our premium mix improved by 2 percentage points of trade volume. Therefore, North is an important market for us, and with this expansion, we will get the desired additional volume. This GU will enable full utilization of our clinker production in the North as well. As an added advantage, this expansion is backed by an active incentive policy by the Haryana government. We are in the process of getting all the necessary approvals for this project. In the meanwhile, engineering design is finalized and negotiations on civil work tenders are initiated. Coming now to sustainability, which is a key agenda of the company. We remain committed to continuously focus on increasing the consumption of alternative fuels, healthy share of blended cements in our mix, and conserving natural resources through efficient waste heat recovery systems, making a positive impact on the environment and maximizing the value creation for our stakeholders. Our Chittor cement plant has established alternate fuel rate capability of up to 23% during FY22. We are also investing in the alternate fuel material handling facilities in Vistas and Nimbol, which should further our commitment towards circular economy. On the green footprint, I am also happy to mention that our Portland composite cement, which we launched during FY22, surpassed the milestone of 1 million tons in the first year of launch itself. This improved our C/K cement to clinker ratio to 1.8x, which is one of the best in the industry. Before moving on to our financial performance, I will briefly touch upon our RNC and MBM businesses. Both the businesses are delivering improved performance. RNC business has witnessed a healthy volume growth of 89% YOY in FY22, with about 53 operational plants pan-India at the end of the year. Its share of premium products increased to about 25% during Q4. We also launched EcoDure, which is a revolutionary range of low-carbon concrete. It demonstrates our commitment towards developing sustainable products to minimize the impact on environment. Revenues from MBM also increased by 59% on a YOY basis. We recently extended our range, including tile application products, with the launch of premium epoxy grout in 23 shades. Now for a quick wrap-up on our financials. Our consolidated cement volumes improved to 17.8 million tons in FY22, while cement volumes in Q4 FY22 stood at 5.5 million tons. During the year, our premium mix improved by 3 percentage points to 34% of trade volume. Trade mix remained healthy at a 75% despite heavy macro headwinds. Our revenues from operations improved by 35% quarter upon quarter to rupees 2930 crores in Q4 FY22, driven by higher volumes and prices taken during the quarter. On full year basis, current revenues improved to rupees 9318 crores in cement. During the quarter, our key cost cement elements, namely material and distribution costs, increased sequentially, primarily due to the inflationary pressure in our key input raw material prices like slag and fly ash, coupled with the increase in freight costs and diesel prices. However, we were able to contain our power and fuel costs and reported a decline of 3% on quarter-on-quarter basis by 1, efficiently managing the fuel mix time to time, 2, receiving slight benefit with improvement in linkage coal supply, and thirdly, by maintaining a good rate of alternate fuel. In these elevated cost situations, we continue to focus on our internal levers, which are under our control. I'm happy to share that we are on track to generate synergies under various levers. Elaborating on our broad initiatives, our price acceleration program has been yielding results with improvement in premium share of products and better geo-optimization. Sales volume of our market-leading brand Concreto has improved by 17% YOY during the year. Project Sprint, which is to get synergies with the integration of New Vistas, has given exemplary savings under various heads of procurement, manufacturing and logistics synergies, along with clinker rerouting initiatives. We are doing further scoping under this project. Benefit also came from higher utilization of waste heat recovery systems. The only lever which largely remained subdued during the year was our anticipated savings from our captive power plants. However, with better availability of linkage coal and softness in coal prices, there is an additional upside of up to INR 25 to 30 per ton through this lever in the quarters to come. Our consolidated EBITDA for the quarter improved by 82% quarter upon quarter to rupees 440 crores. FY22 EBITDA stood at 1539 crores. Some key updates on other aspects of the financials. Despite heavy macro headwinds, we continue to work on improving our balance sheet. Our net debt during the year declined by rupees 1666 crores to rupees 5064 crores during FY22. We have fully utilized our IPO proceeds of rupees 1,350 crores for repayment of debts during the year. Total capex for the year stood at 411 crores. With this, I will end my opening remarks. As this is our full year results, I am joined here by Mr. Jaikumar Krishnaswamy, Managing Director, and Mr. Manish Agarwal, Chief Financial Officer. We are all here to answer your queries. Thank you.
Thank you very much, ma'am. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, may be requested to rejoin the queue. The first question is from the line of Rajkiran Gandhi from SBI Mutual Fund. Please go ahead.
Hi. Thanks for the opportunity. Could it possible to highlight, how has the linkage coal mix moved over the past few quarters, and what is the outlook on linkage coal availability?
Okay. Yeah. Thanks, Raj. I think we had a very good position for linkage coal in East. That's traditionally been the condition for the company. We used to operate close to about 30% of our coal requirement through linkage in the last year. And however, since Q3 of last year, when the overall coal issues became a problem and the government started curtailing coal supply to cement companies, our Q4 linkage coal came down to about 19% of our total coal requirement. And we hope from February, March onwards, the situation is improving. And post-summer, we are of the opinion that more and more coal will be made available. And then we should reinstate back to 30% of our fuel mix from linkage coal.
Okay. Sure. And, from a near-term outlook, it seems challenging due to margin pressure and, cost pressure and all of that. However, let's say from a long-term perspective, how should one interpret your guidance on zero net debt over the next 3-4 years? Would you not undertake any major expansion outside of Gulbarga?
Yeah. I think, let me just answer you this question in a little bit of a granular matter. As per our business plan, we will become a debt-free company by FY26, even after investing in Gulbarga project. That is what we have been mentioning in the past as well, in the past call. However, we plan to get on the growth path, which is the ambition for our company, provided attractive opportunities arise before as well. Looking at the size of the business, we would like to mention here that the company can keep a reasonable amount of net debt in the range of 3,500 to 4,000 crores, while simultaneously looking at good growth opportunities time to time with due clearance of the board. We currently are having ongoing clinker capacity expansion in Risda and Nimbol through debottlenecking, while we also prioritize our plans for 1.2 million tons, as Meeta spoke a little while ago. Both these projects will continue in this year. Just to kind of sum up on what I said, business plan very clearly says with Gulbarga we can become a debt-free company by FY26. However, if good growth opportunities arise beforehand, we are comfortable to retain a debt level of 3,500 to 4,000 crores and still invest for growth in the company. Hope this answers your question.
Sure, sir. Thanks a lot.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital Markets. Please go ahead.
Yeah, thank you. Sir, so first coming on the revenue front, so two things on the volume and second is on the pricing. So how do we see the volume growth for this year? And in terms of the pricing, so post March or maybe from the average of Q4, how much price increase has happened in the east and northern markets?
Yeah,
I'm asking for us how much we are able to take the price hikes.
Yeah, clear. I think I'll ask my colleague Meeta to answer your question.
Thanks, Shravan. We expect East India should witness a double-digit demand growth in FY23. There is a pent-up demand given the previous COVID impact and the government's thrust on infrastructure development and low-cost housing, also keeping in mind that we are in the run-up to a general election. Presently, the situation is a bit volatile, but when we look at the FY23 growth perspective, particularly keeping East in mind, which is our largest market, we have to keep in mind that FY22 had a very disturbed 4-month period. So given the FY22 base levels, we are confident of a double-digit growth in this year. Coming next to the question on prices, we took price increases in Q4 FY22, which have sustained and is giving us benefit in the current quarter as well. In April 22, we again took some price hikes of up to 30 INR per bag in North, and in East up to 15 INR per bag, which is still largely sustaining. Price hikes are going to become essential to offset the soaring input cost, and we would be working on this in the months to come. But most importantly here, since you asked the question of what we will be doing at an organization level, we will continue to focus on our internal lever, which is the price acceleration program, improving our premium product share in the mix and looking at a better geo-mix optimization. I would also like to round up by saying that despite the headwinds, we have ended the year at a very healthy 75% trade share in our business.
Okay. So the related question is still I will come to on the costing front, but before that on the revenue front. So in terms of the RMC, so this year around 766 crore RMC plus other segment. So how do we see this revenue to go up in FY23?
Because it will be a little bit of forward looking for us to tell what will be the number we'll hit for ready mix or any other business in FY23. But I think it's suffice to say that last year FY21 was a totally crippled year with COVID. FY22 we kick-started the business, and H2 FY22 was a very good run rate at the rate of close to about 70 crores per month was the average number in H2 FY22. And I think if you're going to continue in a similar trend in FY23, I think that's the number which we can aspire to get, which will be a healthy growth over last year's actual. That's the way we are looking at. We are also having additional plans to set up new ready-mix plants across the country wherever markets are growing, and profitability and business model is attractive for us. So that's how we are looking at ready mix. We will continue to grow in FY23, and I think from then on, I think as we have mentioned before, our ambition will be to kind of get aggressive growth in this business, keeping in mind profitability as well as ROCE for this business. On the MBM business, I think we hit about close to about 60 crores last year from a previous year's number of 38 crores. Here again, our ambition is to grow at least double digit, if not much more, to grow this business to much higher levels in fiscal 23.
Okay, got it. Sir, now coming on the costing.
So sorry to interrupt, but for any follow-up questions, may we request you to rejoin the queue, please. Then a reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, thank you for the opportunity. I have first question on the capex. So, what is the overall capex in FY23-24 we are looking at? And with respect to Haryana GU, what is the timeline of commissioning that we expect? And lastly, on the Gulbarga, I mean, where are we in terms of the progress? Have we committed to it, or still under evaluation whether we should go ahead or not, given a leverage situation?
Okay, let me just answer one by one. The first question you answered was total capex phasing which you're looking at. Last year, as mentioned by Meeta, our capex spend was close to about 400 crores. This year, we have a plan to get 500 to 600 crores of capex, primarily focused on debottlenecking in Risda and Nimbol clinker. Then we'll also start investing in the Bhiwani grinding unit of 1.2 million tons. And lastly, railway sidings in a couple of our plants and various other routine land capexes for this year, amounting to about 600 odd crores, 500 to 600 odd crores in fiscal 23. Beyond this, as you asked a question about Gulbarga, yes, we are committed to Gulbarga. Like we mentioned last time, the target to start Gulbarga will be early FY24, and we will do groundbreaking around that time. And like we mentioned in last call, Gulbarga is going to be a 6,000 TPD line, and that would entail close to about 1,500 crores starting from fiscal 24 all the way to 25 end. And this company will have Gulbarga in place, the other routine capexes which we spoke. So just bottom line, 400 crores last year, 600 crores this year, and next year Gulbarga will kick in, and then on the company expands. As regards to your question about whether we are committed to Gulbarga based on the current leverage or not, as mentioned in the earlier answer, we are comfortable maintaining a debt level of 3,500 to 4,000 crores on our books. And the decision to kickstart Gulbarga, groundbreak Gulbarga, will be based on the current year's operational performance based on the external factors. We will have to wait for a couple of quarters from now for us to very clearly say at what stage in a fiscal 24 Gulbarga will kick in. But suffice to say, give or take few months here and there in fiscal 24, we will start our construction in Gulbarga.
Okay, got it. Just a follow-up. So when do we expect this 1.2 million ton grinding unit to commission? And with that, is the math correct that we'll reach 25 million ton capacity on grinding and 12.5 on clinker by end of next year?
So as mentioned to you, I think the grinding unit engineering design is underway. Negotiations are already underway for equipment and civil tenders. We are still working with the other statutory approvals to do groundbreaking. Our target is 15 to 16 months from now for the GU to be in place. So by fiscal 24, sometime in Q3, we should have the full capacity of 25 million tons kicking in for us to be available for fiscal 25.
Okay. Just second question on...
sorry to interrupt, but for any follow-up, may we request you to rejoin the queue, please. The next question is from the line of Pinakin from JP Morgan. Please go ahead.
Sure. Thank you, sir. So 2 quick questions. First, we saw the government acting on steel because they wanted to control inflation. Now, we do agree that cement has cost inflation, but I don't think that's an argument which will hold with the government, given that cement companies are making profits and steel has seen coking coal cost inflation. In that environment, how difficult should it be to raise cement prices from here, given that for the end consumer, cement is as big a problem in terms of cost inflation as it is as steel was?
I think you answered the first question, or you answered part of the question yourself. Basically, I think the cement industry sector is clearly impacted by cost inflation, input cost inflation. However, having said that, I think we all work in a sector where I guess you have to kind of respect each other, and the pricing has to be sensible so that we don't lose our market share. So if the prices are going to be impacted due to market conditions, I think we are not going to be left behind, and we'll be very clear to gain our volumes. As regards what can we do to kind of impact on our profitability, I think it's a tough answer to give. We have, as a corporation and an industry, we need to maintain our profitability, but you would know very well that coal inflation is continuing to be high, and the current forecast is it might even get how far it will go. So it's very tough to say that whether we could kind of curtail the prices. But certainly, I think if market conditions practice, we would not be behind.
Understood. So my second question is that if we do not see any improvement in the cement industry dynamics for the next 12 to 18 months, I mean, the industry has been now, this is the third quarter where industry profitability is under pressure. I mean, is it fair to say that before profitability improves substantially, the company would not start spending on Gulbarga, or will the company be okay even with this current balance sheet and current level of profitability of 700 to 800 rupees EBITDA per ton to start spending aggressively on Gulbarga?
I think I answered this in my previous question, but I can repeat it certainly one more time, Pinakin. As I said, as per the business plan which we crafted, we would become a debt-free company by FY26, including Gulbarga. However, if other attractive growth opportunities come, we are okay to run the company at a debt level of 3,500 to 4,000 crores. That's the first assumption and the comfort level which we have. Also, I answered in the previous question, because of the current market conditions and the high inflationary position, we would wait and watch during the course of this year how the overall profitability happens, and then decide the actual kick-starting of Gulbarga, which currently stands early FY24, but based on the coming 1 or 2 quarters, during our discussion, we will share with you whether the whole thing could be moved by few months ahead. So that's the way we look at, but we are committed to having the expansion going.
Thank you. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Hello. Yeah. Good evening, sir. My first question is on efficiency. So talked about the 250 rupees per ton savings over FY22-23 like during IPO. So how much of that is realized, and which particular segment got realized?
Yeah, I'll ask my colleague Meeta to give an answer to this.
Right. So we had just do a quick recap of all the projects we had identified under this bucket. First was the price acceleration program. Second was our full utilization of waste heat recovery systems and captive power plants. Third was our project sprint, which is synergies from the Nuvista acquisition. And fourthly was the incentive benefit from our various plants. So each of these levers are working well. In my initial opening remarks, I have already shared an update on very good concreto growth and geo-optimization. We have been doing very well on all the sprint levers, which is your manufacturing synergies, clinker rerouting, procurement synergies, and new products like composite cement. Our incentive program is also under control with very good capacity utilization in the new plants through the acquisition, as well as in Jojobera with its capacity expansion. The only area on which we have had a little bit of a setback is the optimal utilization of the CPPs, which was impacted due to non-availability of linkage coal. But as this linkage coal situation improves, we see a good upside coming out of this lever, almost to the extent of 25 to 30 INR per ton. So the projects individually and collectively are well on track, and we see ourselves meeting the targets in full.
So where are we, I mean, in terms of 250 rupees, where are we in terms of achieving efficiency? So this.
As I said, we are on track, and the 250 outlook was over a 2-year period.
Sure, ma'am. Second question on cumulative price hikes till May from December levels in eastern and south, eastern and northern market, and how much of it is in April and May month?
So in the month of April, as I mentioned, that in Q4 we saw price increases broadly up to INR 30 per bag from December exit levels. These have been holding out, and we are seeing the advantage into the Q1 of this financial year. In April, we have taken some further price hikes of about INR 30 per bag in north and up to 15 per bag in east. But I'd like to reiterate here that our focus primarily remains on driving our internal lever of the price acceleration program with 3 legs to it, staying focused on enhancing the trade market share, improving the geo mix, and stepping up our percentage share of premium products. We understand that the market is in a competitive stage. There is a lot of cost-driven inflation. We will look at driving the market as the demand improves, which again we are into the best quarter, and the cost inflation will remain a key driver in market price corrections.
Thank you, ma'am, and all the best.
Thank you.
Thank you.
The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Previously, you mentioned 6,000.
So sorry, we lost you for 2-3 seconds at the start. If you can just repeat your question.
Hi, yes, no worries. So first question is a follow-up on Gulbarga. Previously, I understand the expectation was 6,000 ton per day clinker and another 1.5 million ton of GU, and the capex for that, if I understand correctly, was 1,500 crore. Now with the volatility in prices for input and the overall inflation that we've seen, does that number still hold? And tied to that is there a possibility of a delay in capex, or if you delay the capex, given the mine has been around for a long time, you risk losing the limestone mine? That's the first question.
Okay, the answer to the first question is, I think we are quite comfortable on the availability of mines for some more time. So that's not a risk at all for the company if we delay the Gulbarga project for some time. So that's not an issue at all. Number 2, you asked about the configuration of capex, IU or IU plus GU. So when we decided to go for a 6,000 TPD line, we have now stuck to an IU at the initial phase, and as the market develops, we will get into an IU plus satellite GU. But that's how the capex of 1,500 crore has been scoped in the Gulbarga plan. As regards to timing, I spoke earlier, so we will look at early FY24 or a few months here and there based on current year's performance of the market.
So there's no capital cost inflation on that, is that what you're saying?
No, as we see today, we don't see any capital cost inflation, but I think we'll have to see, I think, because things will evolve during the year, and I think in the coming 1Q or 2Q calls, if there is any big shift, I think we'll give an update.
Second question is a follow-up to the previous question. Thoughts on the 3,500 to 4,000 crore debt that you mentioned, that if you get some opportunities. Now, if you have to look at the landscape and possible opportunities across inorganic, organic, and maybe across regions, and not just regions, but across products, because you're now building strength in modern building materials, RMC and stuff. Are there certain opportunities that would be a no-go? Or are there any opportunities within that pecking order that will be more attractive in terms of regions, organic growth within cement or modern building materials? How do we understand any opportunities that you may look at in future?
I think when I mentioned that it will be on the right opportunities, it had few things. I think all of us work in the building materials industry, and for cement, certainly limestone is an important need for going for a growth. I think there are opportunities. If you really look at our limestone map, we have adequate limestone in many places. I think if we get all the approvals going, then we should kind of look at other places other than Gulbarga. But as regards to your question, whether there is a clear no-no or SS, I think it will be very difficult for us to express that in this call. But certainly, I think we would be focused on building materials sector, which consists of cement, ready mix, and MBM.
Okay, thank you so much.
Thank you. The next question is from the line of Urmik Chhaya from Asian Market Securities. Please go ahead.
In the consolidated cash flow, increase in current liabilities and provisions is 4.93 billion rupees. Can you explain that? Is it basically straight payment to transporters?
So, good afternoon. So basically, this is coming on account of the coal purchase that we have done, and as a part of the procurement strategy, most of the coal and petcoke that we have sourced is on LC terms. So that's what you are seeing in the payable side and the working capital.
And
we can go in granular details later after the call if required.
Okay, if I can squeeze one more question, can you give the fuel breakup of Q4?
Can you repeat the question, please?
Fuel breakup Q4. Sorry, I am in a public place.
Fuel breakup, yeah. So as we mentioned, Q4, if you really look at the fuel mix, we are operating at a linkage coal of about 19%, non-linkage coal of around 42-43%. I just can't recollect the exact number. It is in the range of 42-43%, and petcoke would be in the range of about 30-odd%. And most important thing is we have been able to successfully ramp up the AFR to about 6+%, which is very big shift for our company from the past period. Considering the fuel cost prevailing, the thrust of the company, as we mentioned before, is to kind of focus on AFR. And the most important thing is right now we are on two CapExes, one in Risda and in Nimbol, to the tune of about 45 crores to make these two plants alternate fuel capable. So that should kind of help us improve the reliability on alternate fuel rather than depend only on fossil fuels.
In FY22 also, the cash flow from operation was not sufficient to meet the debt repayment obligation, including principal and interest. And that has been the case for almost last 5 out of 6 years. So in such a situation, why are you focusing on debt-funded expansion?
No, the question is the question being asked is, in spite of all the issues according to him, we have not been able to, we get stressed on cash. How do we fund our capex going forward? So maybe you can explain to him the cash flow position for the company in fiscal 22.
Yeah, sir, basically, if I look at the current maturity of long-term debt in FY21 annual report, there was 1883 crore, plus the interest outgo. Your cash flow from operations in FY22 was less than 1300 crore rupees. So obviously the IPO helped in repayment of debt, and the situation that I talked about, CMLTD and interest, has been the case for almost last 5 years out of 6. So that's my basic question here. Why focus on debt funded expansion in such a situation?
Just a second. Yeah, I'll ask my CFO to answer this question.
Yeah, so basically if you look at the numbers for the current year, So the operating cash flow is going to take care of the debt that is going to be falling due, the net debt. And obviously, in terms of the interest cost, I would like to just harp upon this point. A substantial portion of our interest cost is on a fixed basis. So despite the fact that there have been hikes in the repo rate and some of the loans are related to the repo rate. So overall, that is on the interest side. Given the fact that in FY23 also, we are also repaying a good chunk of our debt, and also in FY22 and H2, we paid more than say close to 1,500 crores, and in the entire year we paid close to 2,200 crores. So the benefit of the entire interest reduction we are going to see in FY23 as compared to the FY22. So the whole thing is the operating cash flows for FY23 and going forward are more than sufficient to take care of the capex as well as the debt repayment as well as the interest component.
Just one point, if 23, the repayment of principal is lower than 22 and 24. 24 is again a high repayment year. So again, the same question arises. 23 is fine. What about 24?
Yeah, agreed. I think in FY23, first of all, I think this year we are pretty comfortable with the current business plan which we have in the current market conditions. It will be quite comfortable for us to service this kind of debt as well as fund the capex of close to 600 crores which we target in fiscal 23. As regards FY24, it's certainly more than a year away, and I think our optimism is with the whole India growth story. Demand is going to be fueled during the year. And certainly, I think the business leverage will come back in terms of scale, and then the company will be in a better position to generate more EBITDA, and hence the obligation to repay in fiscal 24 should be also be not a difficult one. As regards the question whether we can fund the capex in FY24 or not, I answered twice before. The decision to start Gulbarga early FY24 or a few months later will be based on the market conditions and the overall performance in fiscal 23, which I will address during 1Q or 2Q results.
Thank you. The next question is from the line of Sanjay Nandi from Ratnavali Investment. Please go ahead. Mr. Sanjay Nandi, your line is in talk mode. Please go ahead with your question.
Yeah, thank you, sir. My questions got answered. I'll come back in a queue, sir.
Thank you. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hi, sir. Good evening. Good evening, ma'am. Good to know that the focus is on balance sheet, and for that, even if it is, if need be to delay the Gulbarga expansion. Coming to the near-term performance, could you share what sort of fuel inflation you are building in for Q1 numbers? And do you see the margins improving basis the price increases that you have taken up so far in the Q1?
If you look at our performance on power and fuel costs, we are one of the best in the industry. If the fuel prices continue to be elevated, it will impact the entire industry, which may follow further price hikes to mitigate the soaring input costs. In the elevated cost environment, we remain focused on maximizing our linkage coal for our CPPs, which would mean Risda, Arasmeta, Sonadi and Jojobera. We would get linkage coal for our CPPs. And secondly, getting the full year benefit for running all our WHR facilities in all our sites. You would all appreciate that we have close to about 44 megawatt of WHR, which is more or less the industry highest of 2:1 cement capacity. So we would be able to generate much higher WHR power in the fiscal 23. And the last one is a thrust on alternate fuel, where currently it is at 7%. By end of this year, with both the projects in place, we plan to hit 12%. The current rate of fuel buying is to the tune of about 250 to 260 INR per ton, not INR, dollars per ton of petcoke, and imported coal is about $240 per ton, which is applicable to everybody in the industry. And beyond this, whatever will happen, it will be very difficult for us to say how far this coal prices will reach. This is the prevailing petcoke and coal price.
No, I was more referring to Q1. Basis your, you have a good amount of domestic coal usage, and will that, and with the price increases that you have seen, cement price hike in your market, do you see that the margins of Q4 are sustainable and scope of improvement in Q1?
We mentioned it little bit earlier that the first thing is we are one of the companies which has got a good linkage coal tie-up, and it was not available in Q3 last year. However, since February, March, we have been able to get linkage coal to the tune of about 15%, whereas in the past we used to get as high as 30%. So I think things should improve as we speak, and more linkage coal one is getting. That's the first one which would kind of put the overall coal price under a reasonable position. The second one which we mentioned was the whole inflationary position on coal is applicable to everybody in the industry, and I think all of us will face the same pressure. But our focus will be to focus on internal levers to improve AFR, increase the linkage coal availability, try and get more coal for our CPPs and get the benefit, and that should kind of hold us in good stead in Q1 as well.
Okay. And sir, in terms of the synergy benefits compared to FY21 on a cumulative basis, how much we have already achieved in FY22?
Rajesh, as I mentioned earlier in the call, all our projects are on track. You will appreciate that this is a competitive market, and in a dynamic situation, these internal levers give us a competitive advantage. We would be happy to provide any clarifications in a one-on-one call to you.
Thank you.
Thank you.
The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. A couple of questions. First is, sir, can you indicate our debt maturity profile, and if at all, if there are any covenants, if you can please quantify these two numbers, maturity for the 23-24 and covenants if at all. That's the first question.
So in FY23, we are looking at a net debt payment of close to 650 crores, and in FY24, we are talking of close to 1100 crores plus.
And the covenant?
We have sufficient operating cash flows that are going to take care of this sort of repayment schedule.
Right. Are there any covenants?
There are covenants attached to it, but all our covenants we are quite comfortably placed, and there are no risks in terms of any of these covenants. Any specific thing, we can have a conversation subsequent to this call.
Sure. My second question is on the lease details. Basically, we have multiple growth optionalities in the state of Rajasthan. Has there been any update over here, any progress over here? What I'm specifically looking for is three leases. One is Jaisalmer, second is Nimbahera, and third is Nagaur. If you could highlight what the status is, what it could mean for the growth optionality for the company going forward.
Yeah, I guess if you really look at our Rajasthan landscape, so we've got two plants in Rajasthan. One is Chittorgarh, which has got adequate limestone for more than one line. In fact, one line is much more. We've got mines in Aranya Joshi as well as the Sisaramji Khera mines to fire the current kiln. In addition to that, Nimbol, we have a line where we're doing expansion to take the capacity to 6,000 TPD. And then to support these two and our growth ambition in North, we have for what we call announced 1.2 million ton GU in Bhiwani. That's our North landscape as we speak. However, you would know, we also have mines in Nimbahera, we also have mines in Nagaur, and more opportunities in and around Nimbol. There is a positive development in Nimbahera, but I think the matter is subsidies at this point of time for us to comment on what exact stage we are in getting the ML reinstated. I guess a few months from now we'll be able to provide you the right clarity, but we are in a very good position.
So Nimbahera is moving in the right direction. Sir, anything on Nagaur and Jaisalmer?
Nagaur, I guess, is an auction mine. So there, I guess, we have started some mining and supplying a little bit of limestone from Nagaur to our other plants. As we got Jaisalmer, I think during our IPO itself, we mentioned, I think it is not in the scheme of things for us in the next 5 to 7 years.
Sure. And this is very helpful. I'll come back on the queue for questions. Thank you.
Thank you. The next question is from the line of Gaurav Jain from ICICI Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question was just to confirm the increase in prices. Are we saying that we are higher by 30 rupees per bag in East and 50 rupees per bag in South as on date versus the March average?
Gaurav, not South. We are operating in North and East.
North and East.
Yeah. So these are progressive price increases that have come in the month of April. We are barely into 1.5 months of the quarter, so we'll have to see in a dynamic condition how this moves.
Right, but as on date, what kind of price hikes we have been able to take over March exit or March average?
Just clarifying, I was talking market prices. What I said was up to 30 INR per bag in North and 15 INR per bag in East. Just confirming, we are talking market prices here, so this would include a GST component.
Right. That is helpful. Second, on the power and fuel cost, I mean, what kind of expectations do we have given the consumption we are doing for Q1 versus Q4 and then on Q2 also?
I think I explained in granular detail in the previous question. I think I would expect you to refer to the answer which I gave a little while ago.
Sure, I'll do that. Thank you.
Thank you. The next question is from the line of Sarfaraz Bhimani from JP Morgan. Please go ahead.
Yeah, hi sir. Just one question I had. So we said that we'll become debt-free by FY26, and we have done some internal calculations as well. So just wanted to understand what kind of EBITDA per ton we are implying to get debt-free by FY26 against our 4Q number of 770 rupees per ton. Thank you.
I think it's very difficult to kind of say. If it was a normal time, I think I would have stuck my neck out and said, what is our EBITDA ambition and where do we go? But certainly we are in volatile times. But even with these volatile times and the past year's EBITDA and the Q4's EBITDA, we have done our plans and that's how we are projecting a debt-free with Gulbarga by FY26. That's where it is. But I think if the market dynamics change, I think these things would undergo a change. But as it stands today with current prevailing conditions, our business model shows with Gulbarga we can become a debt-free by FY26.
Okay. And sir, to ask this in a little different way, so basically your peers, etc., they have said that, we have not been able to pass on the entire price increase in first quarter of FY23 given the cost inflation. What do you think in terms of how much more price hike you will have to take to pass on the entire increase, so to maintain, say, fourth quarter number or, say, second half FY22 number, EBITDA number?
I think it will be very difficult for us to put a finger and say that this much amount of price increase one has to take to reinstate the profitability of the company. But I think certainly all of us know that what was the fuel price rupees per ton 2 quarters ago and what is the published numbers of all companies in Q4 and full year fuel and power cost rupees per ton. You just subtract the two and you will know what's the kind of delta one has to get to reinstate the EBITDA numbers.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Utkarsh Nopani from Haitong Securities. Please go ahead.
Yeah, hi. Good evening, sir. Sir, I have 2 questions. First, regarding the East market. If we see in March quarter, we operated at 92% utilization rate, and we are expecting East market to grow in double-digit rate in FY23 over a peak base of FY22. And as no major capacity addition is taking place in the East region, whether this indicates that there is going to be a possibility of loss of market share for us over the next 2 fiscal during seasonally strong quarter period.
So firstly, I must thank you because you have said something we have been saying for a very long time, that East is a market which operates at a close to 95 to 100% clinker capacity utilization level. So on a longer term basis, this is a market which is poised for good price recovery. Did I answer your question?
No, actually I was not looking from the pricing perspective, but from the market share perspective, whether this indicates that we are going to lose the market share say, over the next 2 to 3 years from here. till the time
On
new
that,
capacity.
okay. So clarifying our market share, we have confirmed earlier that our going forward plans is to grow in the markets of North and West. So our forward plan did embed in the timeline of FY24, 25 and thereafter, we would be losing some share in East, but we will be looking at establishing a pan-India presence simultaneously during this period, which is well in line with our plans to balance our portfolio across regions.
Okay. The second question, madam, is on the ready-mix concrete segment, where we have seen a substantial increase in our revenue on a quarter-on-quarter basis from 180 crore to 270 crore. But our segmental EBIT has remained flat at -6 crore. So can you give a sense that by when we are expecting this segment to turn around, and what kind of a margin expectation we have going forward for ready-mix concrete?
Yeah, on the ready-mix side, as I mentioned in my earlier answer, I think H2 of last year is when the business got momentum and the scale benefits started kicking in at 70 crore top line, and then appropriate bottom line was coming in. And I think if we were to kind of extrapolate this kind of numbers, which will happen because more or less the market has reached prior COVID levels, so we have a target to kind of grow at the way we have achieved in H2 FY22. As regards the profitability of this sector, I think all of us know very well that one of the focus areas for one of the key metric for our ready-mix business is ROC. Our target is to hit about 7 to 8% ROC in the coming year, and then on, I think with full scale growth in the business and stabilizing to the maximum level in the next 2 to 3 years, as we mentioned in 2-3 quarters prior to this call, our target will be to reach a 15% ROC by FY25. Certainly in the near term or medium term, get about 6 to 7% ROC levels. But certainly the business has started making EBITDA margins, and the nature of the business has undergone a dramatic change. We now have a 40% cash and carry business, focus on premium at 25%, and our credit terms are one of the best in the industry now at about 45 days kind of a credit terms, and we're very clear about what kind of business to participate so that the risk exposure of the company is limited.
So your point is well taken. You have said a similar kind of a reply in the last quarterly call. But my question is that since last quarterly, since December quarter, our scale of operation has gone up by roughly 50%. And still we have posted a -6 crore EBIT loss, which was the same quantum we posted in the December quarter. Why it has remained flat in March quarter period?
Our EBITDA margins has been progressively increased from Q4 FY21 to Q4 FY22 from 0.3% EBITDA to 2.4 to 3. I think that at a YOY we are an EBITDA of close to 3% for the last year. I think as the business hits about the revenue numbers which we are talking, the EBITDA margins will go up, and then that's when the EBIT numbers will also undergo a change. And our target is during fiscal FY23, this will undergo a major shift in terms of moving from where we are currently to where we want to be.
Okay, thanks a lot, sir.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital Markets. Please go ahead.
Hi, thank you, sir. Sir, the simple question right now is whatever the previous participants asked in couple of places, either we haven't clearly answering that we have round have given the answer. Second, we have mentioned that we will give an answer on one-on-one. Why that is the case? Do you think that the one analyst or one investor is important versus others? Third is we are not clearly able to justify on what basis we will be a debt-free by FY23 considering the Gulbarga expansion, and that's where there is 100% disconnect between what you are saying and what the street is expecting, and that is also reflected in your current market price versus which is already 50% discount. So even if either you limit a question to 2 per participants or whatever, you need to justify clearly answering this at the conference level and not at a one-on-one level. So simple question is, we haven't got the clear answer how we will be a net debt-free company.
I think your question has to be short. You can't give a commentary on this call. You basically asked us to clarify that whether we would like to answer certain questions one-on-one or we want to answer a question in this call. That question is fairly taken. Let me just answer your question once again for the benefit of yourself and rest of the other colleagues if they have this question. I think you got to put your line on mute, please, when I'm talking. The first thing we need to be very clear is, multiple times we have explained to you that our business model with Gulbarga leads us to a debt-free company of FY26. However, in the cement industry and building materials industry, with the kind of size and the overall opportunities in this country, we are comfortable having a debt level of 3,500 to 4,000 crores and focus on growth. That is the answer we have given thrice, and this is the fourth time I'm giving this answer. Hope this answers your question.
No, sir, this doesn't answer. So the simple thing is, when we say net debt-free company by FY23, so either you need to say what kind of EBITDA per ton are we factoring, what kind of cash flows are we factoring, because we are giving an end answer and not the process. We are not disclosing the process. So a broad assumption has to be given on what basis we are saying that we will be a net debt-free company by FY26. So what kind of a cash flow from operations in next 4 years, FY23 to 26, we are assuming, what kind of a capex we are assuming, and what kind of a net debt repayment will be there. So then it would give us some answer.
Thank you again. Hold on, gentleman from Daulat. This is precisely we have been telling that if such granular details needs to be provided, we are happy to do a one-on-one call with all of you. Otherwise, on a call on a telecon, for me to explain a table of cash flow statements, EBITDA year on year, and also debt year on year, it is not going to stick in anybody's mind. So we are very happy to answer every one of your questions one-on-one basis. We are not worried about what we are going to say. We are a listed company. We are very proud of the results which we are publishing, and the way we are running our company is wonderful. So I think that's where our stand is. We are happy to address every one of your questions. Please reach out to our investor relations department. We would engage with you as much amount of time as you want us to engage you with.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, so thank you for the follow-up. Just two simple questions. One is, there is a increase in the raw material cost as well. So what kind of inflation are we seeing in other raw materials like fly ash and slag, etc.? And secondly, we got a very long explanation on the coal front, but just to summarize and give a number, what sort of percentage inflation are we looking in 1Q versus 4Q, given that large part of the procurement would have already been done for 1Q 23?
Yeah, in 1Q, we mentioned in our call, coal prices are trending at the rate of $260 USD per ton of petcoke and $240 USD per ton of coal. This is the kind of coal procurement all of us in this industry are doing currently. And this is more or less the same number which was a month ago, 2 months ago. What 265 and 240 happens in light of the Ukraine war and what happens to that part of the world, nobody can predict whether it will go to 300 or 280. It's very difficult for us to say. But currently, this is the price at which we are buying and rest of the people in the country are buying petcoke and coal.
And this is against what in 4Q? Consumption basis?
Well, I guess I'm sure we attend calls of every quarter, and I think that's the kind of number. So if you would have seen our Q3 cost per ton, coal and power cost was 1,280 rupees per ton, and it has come to 1,250 rupees per ton. So more or less Q3 and Q4, the prices of rupees per ton power and fuel costs is in fact made a 3% improvement. So that's the kind of efficiency we brought into the company. But with linkage coal coming in, we hope to rein in the overall coal cost going forward.
Thank you. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead. Mr. Ravi, your line is in talk mode. Please.
Hello, am I audible?
Yes, sir.
Yeah, sir, could you give the MBM revenue breakup for fourth quarter and for FY22 as a whole?
I think it will be very difficult for us to kind of give granular details to every single business inside the MBM stuff. But however, as I mentioned earlier, the entire category gave us a revenue of close to about 60 crores last year, which is much more than the previous year's number of 38 crores.
Okay, so the 60 crore is clubbed under the RMC segmental revenue number, or it is part of the cement revenue, MBM?
It's part of the cement revenue.
Thank you. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just a couple of questions. Firstly, on the working capital side, like you seem to have done a good job on that side. But going ahead, further reductions are not possible, is what I understand. So just wondering, given that cost inflation is hurting everyone, and I believe, generally speaking, margins are looking to trend down. How are you kind of guiding on the cash flow side for this year and next? And on the Gulbarga capex, like when you are building in that capex in 1H24 as of now, what kind of broadly the cash reductions or debt reductions you are expecting till then? I mean, in the context of the cost inflation, I'm saying.
I think let me just answer you not in granular numbers, because as I told multiple times, I think this is a very volatile year with prices going haywire. And with the cost lines going haywire, the market has to take appropriate corrections to ensure that we are able to rein in the margin, which is certainly in Q4 our margins have improved much better than the previous quarter, and also with the overall growth happening, looking into the overall growth in infrastructure or the government spends as well as the oncoming general election. So we look at market with an optimistic lens that there is going to be a volume growth in this industry, and hence there is going to be a revenue improvement, revenue expansion in the industry. As regards cost, it's very difficult as we stand today how high the fuel prices will go. Rest of all the stuff, as my colleague Meeta mentioned more than once, the focus of the company will be to concentrate on internal levers and operational efficiencies to rein in the somehow offset the happening due to external factors. Coming to the cash flow position this year, as we stand today with the kind of April start as well as the outlook which we have for this year, we are in a comfortable position to retire net debt of close to about 650 crores, and with a capex of close to about 500 to 600 crores, and still we will be able to sail through this year. Coming to Gulbarga is slated to start in FY24 early. Based on the performance of the industry as well as our company in 1Q and 2Q, when we meet again, we will be able to give a clear indication whether Gulbarga construction will start early FY24 or it will be moved few months if there is a adverse market condition continue to prevail in the next 1 or 2 quarters.
Sure. Just on that same thing, like, do you also have an option to, let's say, postpone it by a year or two? I mean, is that also possible? I mean, in terms of the regulatory angle of limestone lease expiries and all that.
As I said earlier, as regards the regulatory angle, we've got ample elbow room. That should not be a concern at all. However, it is all going to be based on the performance and the ability of the company to invest, and that's why I said that few months here and there. That's how the entire focus of the company is.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Over to you, sir.
Thank you, ladies and gentlemen, for your engagement on this call. As we come to the end of the call, I'd just like to reiterate, we remain optimistic as the structural demand drivers in India are very favorable. While there are some near-term headwinds on the cost side, we continue to focus on our internal levers which support our profitability. Recent actions by the Indian government should help in curbing the inflationary pressure and drive near-term demand. We are investing in growth and sustainability projects which underpins our commitment towards a sustainable growth. while balance sheet improvement remains a key priority. Personally, I, along with our investor relations team, is available for any clarification required. Do reach out to us. Thank you once again for joining us.
Thank you. Ladies and gentlemen, on behalf of Nuvoco Vistas Corporation Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.